1210 right there, and we got that pop up, and then we got the reversal back down. Guys, I can already tell you, if you just get this random pop back up, sweeping your range high, and it's like this one candle pop up, you can see here, it's a very aggressive pop up. If you get something like that, when you sweep the range high, having a potential model 1 distribution on your Monday open during the Asia session, and Monday open tend to be amazing pivot points, that is not something bullish, okay? That's a fake pop-up to sweep the liquidity, to then reverse it back down. So that's where you simply look for breakup structures back to bearish. And that's where, I'm not sure if you guys all know this, but right here is your market structure low on the 1 minute. That obviously has, it's a bit lower, so price has to travel a lot of distance between the high and the low in order to break structure. And when you have to travel a lot of distance, probably is going to take some time as well, which is not that convenient for the short from an RR perspective, or how fast you could de-risk yourself. But right here, we had this demand zone that was backing up your market structure low. And then you mitigate that demand and you curve back up, leaving a beautiful liquidity trail. Okay. Leaving a beautiful liquidity trail here. In general, if you're watching for a confirmation on a short, okay, and this is that market structure, and here's your market structure low, a way that you can pre-short the breakup structure is by watching that bounce and seeing if that breaks back to bearish right here. And if this breaks back to bearish, that means price can follow the market structure, which would be the first market structure from high to low, making a lower high and a lower low. And you're going to get that rotation back down to this low. But since this low mitigated demand, and now there's no demand remaining here, you can get that rotation down even more. So if your breakup structure is too far away, and then you go up, you bounce from any demand that was remaining in here, and you get that beautiful, like the return zone is an extra, right? It doesn't even need to have a proper return to zone, but you get that bounce for the potential higher low for the higher high. Like this is a decisional point. Either right here, you're going to get a higher low for a higher high, just like this, or you're going to get a lower high for a lower low, and the distribution is supply is in control. Like that's the decisional point. So then when you break your structure back to bearish, that is showcasing that supply is in control, and you're going to get that lower high for the lower low and not the higher low for the higher high. So when your breakup structure is too far away following the market structure from the low up, you can enter on the retest breakup structure. Okay, where you simply retest some of the supply that got created in here, or some extreme liquidity sweeps for the last fuel, the last short filling opportunities from the market maker, and then you reverse it back to the opposite liquidity point. So if there was a proper entry, this was the only structure supply there was, right? And I'm talking 30 second, right? I'm talking 30 second. You can even see on the 30 second, this was the only structure supply that got mitigated. In that structure supply, you had this 30-second order block. So if there is a extreme supply on that move down, it's going to be right here. And then you can see there should be no reason, okay? There should be no reason to go above this point. If price is intended to go down, this is the last supply. If market makers want to fill their short positions, this is the last opportunity. If you go higher than that point, you're simply going to take out that high. And it was just a temporary SFP before the continuation higher. So even if this is not 1 minute structure right there, there's no reason to go above this point. Zero. So that's when you can use your 30-second breakup structures, okay? Because there's no reason to go above this point. If there was a supply zone up here, you can say like, oh yeah, we can do something like this and then dump down. No, if price was intended to go down, that was your rejection, and you shouldn't go higher than that point because there's no reason to, because there's no supply higher or obvious buy side liquidity higher. So this break of structure right here is the optimal entry, okay? That's where you enter. That's where the stop loss goes, because there's no reason to go higher. You can keep your stop loss here, but if price goes above this point, you're gonna go to that high, because there's nothing in here that's gonna hold price down. So if your initial invalidation is right there, but you know if price exceeds this point, you're gonna go to that point, obviously your new invalidation is gonna be that lower point. And then that's the proper entry. Okay, that's the proper entry, especially with this sell side liquidity curve. That's just like the cherry on top. And that's when you're gonna have a proper entry, okay? That's where you can take it all the way down, get a 20-hour short opportunity, find the extreme demand of the move, because you do have an amazing Model 2 accumulation, right? And you find, okay, where is my demand located? Well, right here, this is the only demand in that entire move up. If you lose that demand, below it, there's nothing but liquidity. We do have the opportunity of an extended accumulation as well, as ugly as it seems. So what do? Well, because you have such a good entry, because you understand those concepts, you can now be up 12% when price reaches that point already, okay? So you can be up 12%, you can take out 50%, you can realize 6, keep the stop the same. You know, if you lose, you get stopped out for 0.5, making you a total net gain of 5.5 with your weekly profit goal hit on the Monday morning, and then you leave the rest run. You leave the rest run for lower, and then probably for these lows, right? And it's only by understanding what I try to put so much importance on this. It's not that. The big difference is when people look at me, and I get this question a lot, and I'm pretty surprised by the question. They're like, on how low of a break of structure would you or do you look at? You know, what's the lowest time frame you look for a break? And then I say 30-second, and they're like, oh my god, he's entering on the 30-second break of structure. What a maniac! But here's the difference. It's not that this 30-second break of structure just magically tells me that now we're going to get a full rotation back down. No, I'm already expecting, based on context building, a move down from there. I'm expecting a move down here based on the Model 1 distribution and based on the extreme supply mitigation. Now I just need to find a trigger. I see something to confirm that. And that's when I use the 30-second. Okay? Based on this pullback right here that's leaving behind this liquidity, I'm expecting a lower high, right? I get that extreme supply mitigation. I know if there's going to be a lower high, it needs to be here right now. I'm already expecting it, and then it's just a 30-second break to confirm it.